To ensure that revenues and expenses are properly used within accounting information systems use adjusting journal entries. However, before I explain what adjusting journal entries are, I must first delve into what accrual basis accounting is. Accrual basis accounting records revenues when they are earned and records expenses when they are incurred. To avoid confusion, I'll provide an example. For the revenue side, if you have a mowing business and you mowed a customer's lawn, you have earned that revenue regardless of whether you've received payment from the customer or not. However, for the expenses side, if one of your employees has worked for a week, then you have incurred that salary expense regardless if you have paid your employee or not. Now continuing, adjusting entries assure that both the balance sheet and the income statement are up to date on the accrual basis of accounting. Adjusting journal entries is the fourth step in the accounting cycle and occurs at the end of each of the accounting period after the trial balance is prepared. There are 4 different scenarios when referring to revenues and expenses within adjusting journal entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. Deferred revenue is where cash is received before the revenue is earned. For example, airline companies receive payment before you fly. This is seen by a debit of cash as cash is increasing and a credit of liability as the company has not provided the service. If you then look at the adjusting side, you can see that the debit of the liability and a credit of revenue as the service has been provided. This is often called the general rule. Accrued revenue is where the service is provided and cash is received after. For example, when you visit the doctor, you pay after the service has been provided. This is evident in the adjusting entry where receivables are debited as they are increasing because payment has not been received and revenue is credited as the service was provided. At the end of the period, cash will be debited and receivables credited as the service has been paid for. Deferred expenses are where cash is paid before the expense is incurred. For example, a business may pay for 3 months' worth of rent in advance before even using the rented space. This is evident where prepaid assets are debited as they are increasing and cash is credited as it is decreasing due to them paying for the rent. For the adjusting side, expenses are debited as they are increasing and prepaid assets will be credited as the company has used up some of this asset. Accrued expenses is where the expense is incurred and payment is made after. For example, businesses pay their employees after the employee has provided labour. This is seen in the adjusting entry where expenses are debited as the employees performed labour and salaries payable is credited as the company owes its employees for this work. The entry after the end of the period shows the salaries payable being debited as the company has paid the employee's salaries. Thus, cash will be credited as it is decreasing.